Have we gotten this question? You guys must also know how to look for questions very fast. April 2023, question number 3B. It's question number 3B, not 1B. Question number 3B. It's question number 3, boy. Question number 3, boy. Once we get the question, you guys, please put up your thumbs like this, live like this. Today, I'm doing this class from our studios in town. I decided to change location. In life, you must always keep on changing locations. You don't just stay in one place throughout. No, change location. Change location. Great. So we are told here in this question, no, I think these were done, isn't it? This already we are April. No, we haven't done this one of Albert Onchiri. Albert Onchiri, a finance manager at Wema Limited, is considering investing in shares of Safari Airways, a company quoted at the Securities Exchange. The returns on the Securities Exchange Index and Safari Airways shares are shown below for the 5 possible states of the economy that might prevail next year. So they want me to do something very easy. They want me to give them the expected return of Safari Airways shares. So is that correct? April 2023. Is it the correct question that we are reading? Yes, Safari. Question number. I read it wrongly. It's April 2022. It is April 2022. Thank you so much for bringing that to my attention. Thank you so much for bringing that to my attention. I'm so sorry. It is April 2022. It is April 2022. Question number 2. Question number 2B. Question number 2B. Sorry for that. April 2022, question number 2B. April 2022, question number 2B. Now, once you get it now live, put your thumbs up like this. Somebody is saying that, Mwalimu, you are very confused. I can never be confused. I'm a serious ninja. I can never be confused. Never, ever. Never, ever. It's just a mistake. It's just a normal mistake. And a human being is prone to mistakes. So Albert Onchiri, now we have the question. Albert Onchiri, a finance manager at Wema Limited, is considering investing in shares of Safari Airways, a company quoted at the Securities Exchange. The returns on the Securities Exchange Index and Safari Airways shares are shown below for the 5 possible states of the economy that might prevail next year. So I can see economic conditions, I can see probabilities, I can see market returns, I can see Safari Airways return. And then they want me, number 1, to give them the expected return on Safari Airways. Expected is normally the easiest return to compute because expected return means average return. And for us to be able to get, in this case here, expected return, for us to be able to get expected return, for me to be able to get expected return over a security called who? This is Safari Airways. Call it SAF. Expected return of SAF. For me to be able to get expected return of SAF, what I'll do is to take the returns of SAF given times their corresponding probabilities, and then I sum. Like that. Now, ladies and gentlemen, what I will do pretty fast here, I can see the actual returns of Safari Airways. So I can see the actual returns given there. The first one is 13 times corresponding probability, which is 0.15, plus the second actual return is 10 times, in this case here, the corresponding probability 0.35, plus, ladies and gentlemen, in this case here, the next one is 8. 8 times who? 8 times who? 8 times 0.25, plus we have here 4 times 0.15, plus we have here 2 times 0.1. So remember, what have I done? I've taken the actual returns of Safari Airways, multiplied them with their corresponding what here? Probabilities. Multiplied them with their corresponding probabilities. So is there somebody who is able to give us this number, this answer? Anybody who is able to give us this answer, abracadabra? No, I refuse. That is my daughter. They will not be confused. They won't be confused. Nobody will be confused. That's my daughter. Hata kini abuse, you know, when a daughter abuses you, unanyamaza tu, sasa utamfanyia nini? Lakini usikamkemee sana. Usikamuishi mabaya. Daughter ni daughter, ataleta ng'ombe. So very good. So even if they have not asked us, ladies and gentlemen, in this case here, to give them expected return of the market portfolio, I would still go ahead and provide it. I would want to provide the expected return of the market portfolio. So is there somebody who is able to give me this expected return of the market? Is there anybody who can give me this expected return of the market using the same concept? So expected return of the market, I know I would want to use this sometime ahead of this question. Of course, I would want this. So 25 times 0.15 plus, we have here 20 times 0.35, 20 times 0.35. We have in this case here plus 15 times 0.25 plus 10 times 0.15 plus 10 times 0.15 plus 4 times 0.1. 4 times 0.1. So what do we have there as expected return of the market? So Sony is giving me 16.4. I can decide to leave the percentages out like that. Now, so at least issues to do with the expected values that I've been able to get. Now from there, they want me to give them number 2, what Mary Ann does not like. The correlation between the returns on the securities exchange with the returns on Safari Airways. So they want me to give them the correlation between the returns on the securities exchange. Which securities exchange is our market? Securities exchange is our market. It's like our Nairobi Stock Exchange. So basically, they want us, ladies and gentlemen, to give them the correlation, number 2. They want us to give them the correlation between, in this case here, Safari and the market. Is there somebody who can give me the formula? Safari will be using S alone. Anybody who can give me the formula? Correlation R. Write your R in a better way. Correlation R. I think the ninjas who are not getting the question. The ninjas want to get a question. April 2022 is different. No worries. We shall not panic. What we do, somebody who has access to this question, regardless of where it is, I could have confused because of the revision kit. At times we make issues kidogo revision kit. Is there a possibility of somebody taking a screenshot of that question and then sending that screenshot to our various WhatsApp groups, morning, evening, SPR? If somebody can do that to me, it will be very, very, very good. It will be very, very good. So that ninjas can stop confusions here. The spirit of confusion in this case here, it does not exist amongst us. It should not exist amongst us. From today and the whole of next week, no confusion. Done. So now I believe now everybody has it. Thank you so much. And I can see students are giving me very good answers there. Eljoy has given me a video here. Is it a video or Eljoy, ini gani tena Eljoy unatuma hapa? Or a crazy one. Somebody yawning. So R, the correlation coefficient between two securities. Correlation. So first of all, we shall get the covariance between S and M. The covariance between S and M divided by the respective security standard deviations like that. This is how we get the covariance between. The two securities here. Covariance between SM divided by the standard deviation of S and the standard deviation of what here? M. So first of all, then we shall be able to get the covariance between S and M. Is there somebody who is able to remember the formula of covariance? I love covariance formula because this is the formula of co-wife. Formula of co-wife, I will never forget. Co-wife. So when they tell me to give them covariance between S and M, I know I will take the deviation of S. I multiply this with the deviation of who? Deviation of M. Then I multiply this with probability, and then I will sum. Because now here, there are two ladies involved, covariance, the shared variance. Yeah, thank you, Catherine. Deviation between securities, yes. So you take the deviation of S multiplied by deviation of the first one, multiplied by deviation of the second one. So how do we get this deviation of S? It's very easy. You will take RS minus ERS. Unaweka bracket hivyo. Alafu kuna deviation of M returns. So in this case hapa tuko na RM minus ERM. Una multiply hapa nje na probability. Alafu unakuja unafanya nini? Una sum. Alafu unakuja unapanga maneno hapa. Unapanga maneno hapa kama president wetu, maneno mzuri. So unaanza na, okay, tumeandika no problem, we can do it either. Lakini sababu tumesema hapa returns of safari, unaandika hapa 13, 10, 8, 4, 2, minus. Are you able to remind mwalimu what the expected return of safari was? Expected return ya S ilikuwa ngapi? Expected return ya S ilikuwa ngapi? According to Bwana Stanley, it is 8.25. And what do you know about expected return? It shall always remain what year? Expected return shall always remain the same. This one here does not wobble. It's not a wobbly figure. Not like how a rickety vehicle wobbles. A rickety old jalopy of a vehicle. So this one does not wobble. Does not wobble. Then we come to returns of the market. The returns of the market, I can see them there. This, without E, this means actual. The ones given here. So we have 13, 10. No. It's for the market. 25, 20, 15, 10, 15, 10. And then we have 4. So minus. Are you able to remind us what this expected return of the market was? Expected return of the market, in this case here is 16 point what year? So in this case here, we have 16 point what year? 16.4. So we have a ninja who has been around thinking we are doing AFR. We shall overcome. Don't worry. 16.4. Then please don't forget our probabilities. Don't forget our probabilities. So our probabilities are given here. So we have here 0.15. We have here 0.35. We have here 0.25. We have here 0.15. We have here 0.1. Those are the so you give me these answers. Pole, chukua calculator yako pole. Mwendo wa aste. Unasema open bracket 13 minus 8.25, you close. Times open bracket again, 25 minus this, you close. Times 0.15. Alafu nipatia final answer ya kwanza. According to Madam Mary Ann, 6.1275. Like that. Hiyo ndio ya kwanza, 6.12. So this is 6.1275. Yeah. And J, 2.205. Hiyo ni NJ. Pia tuko na Masi Kosencha Muneria. I've never taught this lady before. This is the first time I'm teaching her, and it's good that she's able to give me answers. Very good. So we go to the third one. The third one, what do we have, ladies and gentlemen? Please, everybody must punch. Unfortunately, there are students that you can't really help. No. There are students you can't really help. Sababu ukiwaambia tafinya calculator wako too lazy. Hawezi wakafinya hata siku moja. They're not lazy, but I mean, they're doing so many things at the same time. Kawaida, ile kitu unafanya sana mwingine saizi, unapata nafinya ugali moto. Na anaangalia FM moto. So kila kitu nakuwa moto. 875. The last one is 7.75. The last one is 7.75. Thank you very much. And then the second last is 4.08. Thank you very much. So remember, we want to sum. Now we want to sum the whole of this. So come and give me the summation here. So this will be the covariance between S and M. This will be the covariance. So 20.25. Thank you very much. 20.25. Great. Now from there, ladies and gentlemen, now I want the standard deviations here. I want the standard deviations. I'll not struggle with standard deviation. So is there somebody who is able to remember the formula of standard deviation? So to get the standard from the name itself, standard deviation, I'm subtracting. Subtracting what returns? The deviation, normal deviation, which is RS minus ERS. And then we shall be able to come here and do what? A square. And then we shall be able to come and average by multiplying with this with probability. It can't be standard deviation if it doesn't have a coefficient. It must have a coefficient there for it to be standard deviation. And remember now, once you have these ones, so what I'll be doing is just to take the ones of S. So I have here 13 minus 8.25. I have 10, I have 8, I have 4, I have 2, minus 8.25, 8.25, 8.25, 8.25. Unakuja hapo unaweka namna hii. Squared times probabilities. So our probabilities we are following, of course, we have them. They'll be used throughout. 0.15, 0.35. Then we have, ladies and gentlemen, 0.25. Then we have here 0.15. Then lastly, we have 0.1. Equals. So again, unaanza na ya kwanza. Kwa furaha, unasema open brackets, unasema 13 minus 8.25. 13 minus 8.25, close bracket, unasema squared, times 0.15. Give me an answer to write there. The first one, according to NJ, we have 3.384. Tunaweza kuziachia hata hapo 3 decimal places ni sawa tu. Tunaweza waachia hapo. Tunaweza weka sisi wote consistent 3 decimal places, consistent 3 decimal places. Oh yeah, Madam Joy. Unakuja hapo unasema open bracket 10 minus 8.25, close. Don't say equals. You square whatever answer you get times 0.35. So according to Mary Ann, this is supposed to be 1.072. Tumesema 3 decimal places, all of us. We shall be very consistent with the 3 decimal places. Paka tumalize hesabu yote. The last one, according to NJ, is 0.906. Tuko na ingine hapa ambao ni 1.072. Vero. Aha. You promised to improve the handwriting. It's like they're not seeing very well. I thought I've really improved. So wanasema the second one is wrong, eh? Wanasema nimeandika hii. Wacha muone sasa. The third one is supposed to be 0 point. The third one is supposed to be 0.016, 0.016, 0.016. Aha. Alafu sasa unipatia the fourth one. The fourth one, which will be the last one in this case, which is 2.709. 2.709. Great. Thank you so much. And then now we want to get the total. Now we get the total. So according to NJ, the total is supposed to be 11.087. According to NJ, Catherine has confirmed. So remember, this is what we call variance, isn't it? This is what we call variance. And therefore, standard deviation of S will be the square root of the variance. Unaona sasa. Unafuata tu formula. Formula imesema kwanza, you get the deviations squared times probability. And then you sum them first. Before square root. So they're getting, what figure are they getting here? They're getting 3.330, like that. Standard deviation of Safari, or 3.329. That's okay. So can I move on to something different, which is standard deviation of the market? Can we go on to standard deviation of the market? Yes. So then let's come here and provide the standard deviation of the market. Now we are getting the standard deviation of the market. Standard deviation of the market. Can I wrap this thing? Yes. Thank you so much. So then come and give me the standard deviation of the market. So come here and give me the standard deviation of the market. So I will start first of all by writing the formula, standard deviation of the market. So the formula, standard deviation of the market, inakuwa ni differences between two returns. Which returns are these? We have RM minus ERM. And then we come and square this times probability, because there are many, we sum. And then square root like that. Square root like that. So unakuja unachukua karatasi yako, unakopi kwanza the actual returns of the market. Actual returns of the market, hapa tuko na 25. Hapa tuko na 20. Hapa tuko na 15. Hapa tuko na 10. Hapa tuko na 4. Minus. Expected returns of the market, you guys had given me a figure of 16.4. If I'm not wrong. Expected return, mkome nipatia 16.4. 16.4, 16.4, 16.4, 16.4. Alafu tunakuja hapa tunaweka namna hii, tunasema squared. Times now probabilities. Times probabilities. So probabilities, what do we have? The same probabilities. 0.1, and I like Dennis. Dennis is really giving me figures there. 0.15. Then we have 0.35. Then we have here 0.25. 0.25. Then we have here 0.15. Then we have here 0.1. Now we can write these answers here. Now we can write these answers. So already Frida na Deno wamenipatia figures. Frida na Deno wamenipatia figures. Wameniambia ya kwanza ni 11.094 ya kwanza. Ya pili wameniambia ni 4.536. Wakakuja wakaniambia ya tatu is 0.49. These are great ninja. 0.49. Alafu wengine nakuja 6.144. 6.144. Alafu sasa hii inakuja inakuwa 15.376. 15.376. So unakuja hapo unanipatia total. Unakuja hapo unanipatia total. Unanipatia total, woye, inakuja ngapi sasa? Total. Sasa tunasema kuhusu total 37.64. 37.64. How is my camera? Is my camera really visible? Are you guys able to see what I'm writing? Or is it blurry? As somebody is telling me there. It's visible. Oh, it's not visible. It's not visible. Blurry, yeah? So I'll be able to do something. Ikiwa mbaya, nitawachange. Niko na kamera ingine nimeficha mahali. Kama ya nyumbani. Kamera kubwa kabisa. So standard deviation of the market itakuwa ni square root of 37.64. 37.64. 37.6. Ala, very clear. According to Kerry Odanga, very clear. Chalo, very clear. So anasema inakuja 6.135. 6.135. Thank you very much. Now from there, ladies and gentlemen, I'll be able to move on very fast. Today I'm a changing man. Today I'm trying great things here. Great. Now we put this like that. So then we come and give them, in this case here, the correlation coefficient between S and market, which is covariance between S and market over the standard deviation of S, standard deviation of the market, like that. So fortunately, we have the covariance. Yeah. Fortunately, we have the covariance. What is the value of covariance, somebody? Covariance ilikuwa inakuja ngapi, somebody? Covariance ilikuwa inakuja ngapi? Covariance. Yeah, we shall overcome. Covariance ilikuwa inakuja 20.25 all over standard deviation of S, which we had gotten, which I wrapped. Standard deviation of S, we already have it. 3.33, yeah? 3.33 times standard deviation of M, which is 6.135, like that. Yeah. Which in this case here gives me 0.991, which is approximately what here? 1. which is equal to what here? 100%. You see this is 99.1. So basically, this is a correlation over 100%, which means that the two securities are positively, perfectly correlated. The two securities are positively, perfectly correlated. This is a bad combination. This is a bad combination for portfolio formation. For portfolio formation. So when these things agree like 100%, they should not be combined. They should not be combined to form any portfolio. When it's mirror to mirror, this is like your sister. You can't get married to your identical sister here. No, that will be very, very wrong. All right. So in this case here, basically, we prefer mixing securities whose correlation is negative. If you get, for example, R equals like negative 0.5, negative 0.6, so long as in this case here they are behaving in the opposite direction, those are the best people to put together in a marriage. Si wale ambao wanashikana mkono all over. Wanashikana mkono all over, mara mwisho inaweza kuwaramba. Takule kidogo mna disagree. Because hata tunaambiwa, ukiona mna agree zaidi kwa marriage, mnashikana mkono throughout, one of you is irrelevant. And in most cases, it is the husband. It is the husband. We shall overcome. So whenever you get two securities that are positively, perfectly correlated, those are very bad securities for making a portfolio. Because what does that mean? It means that when the share price of one security, of the security is high, the other security is also high. So both of them in this case are going high. When they are down, as a businessman who is serious with the formation of portfolios, you want in this case here returns that behave in the opposite directions. When one is down there, you have something up there holding upon you. So actually the perfect match are negative 100%. The perfect match are negative 100%. Very good. Okay, great. Great. So we shall overcome. But have you been able to pick some concept here? Have you been able to pick that some concept? Hata ikiwa 80%, hata kwa nyumba mkisikizana mpaka 80%, hiyo sio mzuri sana. Wewe hata ukiona mko hapo 20% ama negative kidogo, hiyo ndio saa the lower the better. The lower the better ama the negative the better. Mtaishi miaka mingi sana so long as msipigane. Kupigana ndio hataki. Lakini ingine ile kawaida, hai. Hiyo ndio mzuri. Maisha yanataka namna hiyo. All right. So now with your permission, ladies and gentlemen, I'll be able to move on, and I know you'll be able to interpret now this very well. I am so sure you'll be able to interpret this in an exam very well. You can't miss that marks interpretation. At wewe mko na relationship which is 100% ama hata 90% perfect. Hey. Kama ile mapasta kwa pulpit. Ati baby tumekula nini leo asubuhi? Sijui tumekula sausage na nini. Sasa tumetoka Kawangware, hatujakula chochote. We international disaster. Very good. So then the correlation between the returns on the securities exchange with the returns on Safari Airways shares that we have done. Roman 3, comment on the results obtained in a B above. So it is either you come where you are written this comment here, you call it Roman 3. Or you come and write Roman 3 down afresh there, and then you copy again that statement. Because you can't come and write Roman 3 and then tell the examiner to refer above. That is bad language. You don't tell the examiner to refer above. Never. You'd rather just copy again. You simply copy again what you had written up there, or you take that number up there. You can't tell the examiner to refer above. We shall overcome. Okay. Wagomba nao ndio wapata nao. Thank you very much. JL. summarize the entire thing. So then we go to Roman 4. Albert Onchiri is thinking of undertaking an alternative investment, but similar to that of Safari Airways shares. If the risk-free is 10%, determine the minimum required return of this investment. Minimum required return of this investment. So this is very easy. I will be able to use CML. I will use CML returns, the portfolio equation. The portfolio equation. So the portfolio equation, we know that CML returns equals risk-free plus, in this case here, we have expected returns of the market minus risk-free multiplied by standard deviation of S all over standard deviation of M. Remember, this is the capital market line, the capital market line, the capital market line. Whenever you hear of these examiners asking you for minimum required return, so it is the CAPM, it is the CML, CAPM, CML. So let's use CML here, CML returns. So then are you able to see, ladies and gentlemen, are you able to see in this case here the risk-free return? Have they given us the risk-free return here? Have they given us the risk-free return? %. The major points only. So 10%, thank you very much. Do we have expected returns of the market from the previous? Expected returns of the market will always remain the same. Always remain the same. Always remain the same, 16.4. 16.4 minus this return. If you wish, you can just forget the percentages. This return is 10%. So do we have in this case here the standard deviation of this security over Albert Onchiri? Remember, he has taken this up to be similar to Safari Airways. So meaning that the risk return will be the same. Yeah. Great. So 3.33. So 3.33 divided by the standard deviation of the market that you guys had already gotten, which is 6. What here? The standard deviation is 6.135. 6.135. 6.135. So please move slowly. We see whether you will be able to get this. So if I were you, I would always omit the percentage. When I'm using my calculator, I will always omit the percentage. So we have here 10 plus open brackets, 16.4 minus 10, you close. You say times 3.33 divided by 6.135, and then you say the final answer equals. So what figure are we getting here? We are 235. I would expect to get answers in this case here from all of you, And then I can see your question there. So 13 point what here? 13.47. I chose basically I chose CML because CML, ladies and gentlemen, if I go for CAPM, I need the beta factor. I need the beta factor. Let's in this case here go for CAPM. Even if you went for CAPM like in this sitting, so many guys used CAPM, they were getting answers which are very close to this. Because you're using the same securities. The answer should be the same. So in this case here, then method 2. So method 2. So method 2, what do we have, ladies and gentlemen, here? So for method 2, what we have here, it's CAPM. CAPM returns. So CAPM returns, this will be risk-free plus ERM minus risk-free multiplied by what here? Beta of the security. So meaning that you must come here and give us, first of all, beta of Safari. Beta of Safari. There are two ways of getting beta. Here, I will use the covariance approach. So to get beta S, using the covariance approach, I will take the covariance between S and M, divide by the standard deviation of M squared. This is the covariance approach. Remember, we have the covariance approach and we have the correlation approach. We have covariance approach, and then we have correlation approach. Covariance approach and the correlation approach. Here we can use covariance because already we have the covariance of S and M. Do you remember that covariance that you had obtained up there? The covariance between S and, was it 13.47? Was it 13.47? 13.47, 13.47. Divided by the standard deviation of the market, which is here, which is 6.135 squared. 13.47 divided by 6.135 squared. So then what is the final answer? Is there somebody? No, they are telling me mwalimu 13.47 ni uongo. Ilikuwa ni ile previous. Wanaambia mwalimu ikitu toa hiyo hapo. Weka 20.25 ndio kitu ya maana. Ndio kitu correct. 20.25 divided by this now. So in this case here, then what will be the BS? Thank you very much, Jorida. Thank you very much, Celestine. So beta is 0.538. Beta is 0.538, like that. Thank you very much. Now, once I have that, I can easily come and provide the KASNEB returns. The KASNEB returns. Risk-free remains 10% into 16.4% minus 10% into now beta which is 0.538. It may not be exact, but it will be really close to what you guys have there. Yeah, 13.44. 13.44. But ladies and gentlemen, I would want to throw caution your way. There are very few students who go to these exams knowing the CML equation. Very few. All of you will be mastering the KASNEB. And in most cases, because examiner, we know that you are good in KASNEB, what we do, we shall always test you, the CML, and we shall always get most of you off guard. Off guard, like that. Off guard. Ukoraba sana, you sija understand JC. JC, I'm so sure in Generation Z language. Oh, niko mbio sana. Okay. You're moving so fast. Which I doubt because I'm able to. I doubt. Perhaps JC also, you should do some introspection. Maybe you're the one who is writing very slow or something. Yeah. What if we use R? Is it R or what is that? What if we use R for beta? Are you the same bwana? Are you asking whether we can use a risk-free for beta? No, risk-free can only use risk-free, for example, as cost of debt. It can't be beta. It can't be beta. It can't be beta. It can't be beta. All right. So JC Naraba, I hope now you have been able to write up to here where JC where I mean correlation. Yeah, it will still be the same. It will still be the same. It will still be the same. Let me repeat. I like those questions because they are helping us. Lakini kwanza tuulize kama JC amefika hapa kwanza. JC amefika hapa kweli? JC amefika hapa. The other approach for getting beta. The other approach for getting beta. The other approach for getting beta. So beta S, so we have two approaches. We have two approaches. We have what we call the covariance. We have what we call the covariance approach. We have what we call the covariance approach. So under covariance approach, beta S is covariance between S and M. Divide this by what here? The standard deviation of the market squared. And then we have the correlation approach. Correlation approach. So correlation approach, BS will be equal to, correlation is R, remember. So it will be R between SM, multiply this by standard deviation of S, all over standard deviation of what here? The market. BS. So the correlation, you take the correlation coefficient, multiply this by standard deviation of S, divided by standard deviation of the market. All right. So in this case here, RSM is 0.2 what here somebody? RSM is 0.991 times the standard deviation of the security. Times the standard deviation of the security. Are they able to remember the standard deviation of Safari? Standard deviation of Safari. Standard deviation of Safari. 3.33. Standard deviation of the one we got up there, the one of Safari, 3.33. So we have here 3.333 all over the standard deviation of the market. 6 point something. Standard deviation of the market was 6 point something. Standard deviation of the market was 6 point something. So we have here 6.135. So the BS you'll get here is the same as the BS you got up there, except for rounding off errors. 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 So mnapata ngapi somebody hapa? Same. Wanasema same. Great. So we have answered that question. We have answered that question. I can see some two ninjas here inboxing me, mwalimu here. Yes, you are too fast. Are you serious, you guys, that mwalimu is too fast? I've done this whole question 1 hour. No. Ni pia mko na shida hata nyinyi sasa naweza hata kama nasema mwalimu I've taken a whole hour in this question. I think what some of you are doing at home, which is wrong at this hour, you guys are multitasking as well. You must be doing other things. You must be doing other things. You must be doing other things. I need even to add a little bit. How many pressure? Maybe pressure. Yeah, because I've taken a whole hour, honestly. There are times mwalimu usikii mambo tunakwambia, lakini kusema kweli pia saa zingine narudi nakwambia wewe pia wache ile mambo unafanya nyumbani ingine. To concentrate hapa. Alafu hata mzuri zaidi usiinbox, andika hapo kwa group ndio kila mtu anaona. Kila mtu anaona. Sasa hebu basi tuende kidogo kidogo. Tuende kidogo kidogo namna hii. Let me take this opportunity to remind you guys two very important performance measures. Performance measures, the Sharpes and the Treynors. I just want to remind you, because now you guys have known how to calculate beta very well. So we shall go to August 2022, question number 5C. August 2022. August 2022, question number 5C. August 2022, question number 5C. Pressure creases now. August 2022, question number 5, cow. Let me know once you guys are able to get that question. Inaharibu hii. They've already gotten the question, right? Okay. Sasa, nataka msikize kimakini sana hapa. Msikize kimakini sana hapa. The following information relates to the performance of 3 portfolios A, B, and C during the year. So they've given us average return. They've given us here standard deviation. They've given us covariance of portfolio return with market returns. Additional information, the market return and the risk-free rate are 14 and 7% respectively. During the year ended 30th June 2022. The standard deviation of the market is 10%. So they want me to evaluate the performance of the 3 portfolios using Sharpe's performance measure. So is there somebody who can write for me the formula of Sharpe's? They call it Sharpe's, but it's supposed to be Sharpe's. So Sharpe's coefficient. Sharpe's coefficient. Sharpe's coefficient will be equal to who? Sharpe's coefficient will be equal to who? Sharpe's coefficient. Sharpe's coefficient will be equal to who? Yeah. Thank you very much. So Sharpe's coefficient, you will take in this case here, expected return of a security. You take away the risk-free. So basically you get the premium. And then because Sharpe's standard deviation, you will come and divide by the standard deviation of the security, like that. So then we have 3 of them, A, B, C. A, B, C. So A, are you able to see A? You see, expected return is the same as what your average return. Expected return is the same as average return. So for A, expected return is 17.55. Minus risk-free has been given down there. 7. Divide this by the standard deviation of the security. Which is 30. Actually, I'm the one who destroyed this thing, who touched this camera. I don't know who told me to touch it. I don't know who told me not to touch it. I think that way may be a bit better now. Better. Okay, great. So then, are you able to give me this coefficient of A? You say 17.55 minus 7. First of all, you get what the answer there is. First of all, you get what the answer is there. Whatever you get, you say divide by a point. Whatever you get, you say divide by 30. Whatever you get, you say divide by 30. So every student should be able to give me that answer. Every student should be able to give me that answer, as I also refill my pen. The student who called me today in the morning, a young girl, and told me that mwalimu sijalala usiku mzima ati ndio nakesha kusoma. Hapana, utaanguka zote. You must sleep for minimum 6 hours. 6 hours. Minimum. So I canceled the lady. You must sleep for a minimum of 6 hours. Kumwenye anakosa usingizi pia kabisa. Kumwenye anakosa usingizi kabisa pia. At whether it was Mary Ann, no. She's here. Anajijua taeleza sema mwenyewe. Oh, sleep is over. No. You need to sleep. Honestly speaking, you have to sleep. You have to sleep. You must sleep. That one I can assure you. Utapita mtihani. Your exam AFM this time round will be very, very easy. The easiest exam ever. So mnasema kwamba this one is 0.35. 0.35, right? $0.35, right? 0.0, 0.0, 0.0, 0.035, 0.035, 0.035. So the first one is 0.035. And then we have a boy. So boy, in this case here, we can see expected return of boy, 13.26. Minus risk-free is the same, 7. Divide this by the standard deviation of boy, which is 34. So is there somebody who is able to give us this answer? Oh, the first one is 0.35. Oh, sasa nyinyi mna confuse mimi sana. The first one, please check out the first one. It's supposed to be, the second one is 0.184. How about the first one? The first one is 0.352. 0.352. So we pick now the last one. The last one, we want expected return, which is the same as average return of the security. Average return of this security, ladies and gentlemen, the average return of this security here is 9.34. So 9.34, we take away 7. We divide this by what here? Its corresponding standard deviation of 28. So ensure that you're putting this in brackets, or you first of all get the numerator equals whatever you get, you say divided by 28. Whatever you get, you divide by 28. So I'm being given a number of 0.084. So then from there, come and rank them. Remember, the higher the Sharpes, the better. So which one in this case here takes number 1? A. So this takes number 1, this takes rank number 2, this takes rank number 3. At times in this case, they'll also tell you to evaluate the market portfolio. So if they told me to evaluate the market portfolio, I would have taken the average return of the portfolio minus risk-free divided by standard deviation of the market like that. So I hope this is clear, ladies and gentlemen, and I hope now we can go straight away to the second part. The second part, now they want the trainers. The second part, now they want the trainers now. The second part, now they want the trainers. So second part, now they want the trainers here. Now they want the trainers. So trainers, we know that trainers makes use of beta. Yeah, makes use of beta. Thank you so much. So Sharpe's standard deviation, Treynor beta. So you'll come and tell us here, Treynor's coefficient, it will be expected return of the security minus risk-free all over beta of the security. But now here, beta has not been given. You must compute beta yourselves. You must compute beta yourselves. You must compute beta yourselves. So I want to see whether there is anybody who will be able, whether there is any ninja who will be able to compute that beta very, very easily. Let me see whether there is any ninja that will be able to compute that beta very easily. Let's see, ladies and gentlemen. Thank you very much. I like what NJ is saying there, that I shall use correlation approach. 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 I shall use correlation approach, which in this case here, they are capable of doing even by themselves. They're capable of doing even by themselves. All right, covariance. So in this case, it's covariance because they have given us, is it covariance or correlation wewe? Hebu soma vizuri, wamekupatia nini? Wamekupatia nini? Wamekupatia nini hawa jamaa? Kola muko. Wamekupatia covariance. Covariance. So kama wamekupatia covariance, use covariance, use covariance, use covariance approach. Use covariance approach. And if it's covariance approach, I know BS should be equal to covariance between S and M divided by the standard deviation of the market squared. So go ahead and give us for A, B, and C. A, B, and C. Let's see. So are we able to see the covariance? Are we able to see the covariance of A? Yes. So covariance of A with market returns is 0.0088. Divide this by the standard deviation of the market. Are you able to see the standard deviation of the market, ladies and gentlemen? Standard deviation of the market, are you able to see it somewhere? So standard deviation of the market, it's 0.1, isn't it? It is 0.1, not 10. I'll read this as 0.1, 0.1 squared. Because the covariance itself is not in form of percentage. If it were in form of percentage, I would have ignored that percentage. So it will be 0.0088 divided by 0.1 squared. So in this case here, this gives me 0.88. This gives me 0.88. Those are the petty mistakes students make. Go to B. So for B, what do we have here for B? For B, I can see the covariance, 0.0750. 0.0750 all over the standard deviation of the market square. The standard deviation is 0.1. 0.1. So I have here 0.1. What here? 0.1 squared. 0.1 squared, which will end up giving us what figures, and gentlemen? 7.5, right? So this gives us 7.5. This gives us 7.5 like that. This gives us 7.5. This gives us 7.5. This gives us 7.5. Then you go to C. You go to C. You go to C. So for C, what do you have there? The covariance is 0.0021. Covariance is 0.0021 divided by 0.1 squared. which will end up giving us what figure, ladies and gentlemen? Which will end up giving us what figure, ladies and gentlemen? 0.21, isn't it? 0.21. So this is 0.21, like that. Thank you very much. Then we shall be able to come and use them here. We shall be able to come and use them here. We shall be able to come and use them here. So then this is what we have as our Treynor's values, Treynor's coefficients. So Treynor's coefficients, Treynor's coefficients. So in this case here, we start with A. So what is the expected return of A? Expected return of A is 17.55. So we have here 17.55 minus the risk-free. You guys had given me a 7. Divide this by, in this case here, beta of A, which is 0.88. So are you guys able to give me an answer? Are you guys able to give me an answer? Mary is asking, why are we squaring? Why are we squaring? Why are we squaring, Mary? It's because the formula says so, Mary. Remember, we have got two formulas, Mary, to correlate a correlation, to a correlation times the standard deviation divided by standard deviation of the market. That one you don't square. But if it's covariance approach, this is the formula, Mary. It has got this squared thing. It has the squared thing. It has the squared thing. I hope, Mary, that is clear. So 11.99. 11.99. If you wish, you can put percentage, or you leave it like that. You leave it like that. And then we have boy. So boy, expected return of boy, expected return of boy, expected return of boy, expected return of boy, 13.26. So 13.26 minus 7 all over 7.5. So this one here will give us what figure at the end of the day, ladies and gentlemen? Fatuma, 0.83, 0.83, 0.83, 0.83. And then we have a C. So C, in this case here, expected return of C. Expected return of C. Expected return of C. Expected return of C. Wamenipatia pale chini kabisa. Wameniambia 9.34. So 9.34 minus 7 all over, in this case here, we have 0.21 all over 0.21. So then this one here will end up giving me what figure? 11.14, 11.14. And then go ahead and rank them. So this takes position number 1. This takes position 2. This takes position what here? Position 3, like that. Position 3, like that. So is that okay? At least if there is anything you are taking home with you today, is a mean consolidation of your knowledge of how we are getting beta, of how we are getting beta. That's very, very important. Elvis, thank you very much. Jensen's formula, I've done it quite a lot. Jensen's formula, I've done it quite a lot. Stanley wants us to get beta under approach 2. Beta under approach 2. The correlation. Do you want us to get, first of all, the correlation there? You can't even get correlation there because you don't have standard deviations. Oh, yes, Stanley. Olimejua, great. Thank you so much. All right. So very, very important like that. But of course, if you get good examiners will examine you like this. But if you get mad examiners like some of us, some of us, we are rough examiners. That's why I don't want to examine anybody in KASNEB. I would rather just teach properly, and then I should never examine. Because if I write an examination for students, I'm so sure very few of them will pass, because I know all the tricks that I can use to ensure that all the students fall under the bus. I fix them under the bus. I can fix all of you under the bus. I would rather not set exams. Because if I'm told to set an exam, this is what I will do. I'll come and give you the buying price of a share. And then selling price is dependent on the prevailing state of nature. The prevailing state of nature, which could either be A, B, or C. So in this case here, A, if it is A, it goes for 35. If it is B, it goes for 42. If it is C, it goes for 38, like that. And then now what I will do, ladies and gentlemen, I'll call this one returns of X. So I'll come under required standard deviation of X. Remember, these are returns of X in what year? In shillings. Returns of X in shillings. Returns of X in shillings. I'm so sure as an examiner here, I'll be able to put under the bus about 80% of the candidates sitting for this paper. But some of them will be able to know the trick. Some of them will be able to know the trick. But 80% of them will go under the bus. They'll be crushed by that bus. They'll be crushed by that bus. Wambui anasema woi mwalimu. We shall overcome, woi mwalimu wetu. We shall overcome. Woi mwalimu, we shall overcome. So if you're given this kind of a question, thank you very much, Jorida. Thank you very much. No. The semester exam ya FM itakuwa rahisi sana. These things nakufunza hapa. The semester exam ya AFM, it will be very, very easy. Very easy. Very easy. Very easy. The papers, I know they could be a bit rough, ni kama AAA, but tumewasaidia sana. AAA tumesoma sana. Ile umefunza na mwalimu Kenyani, ile nimekufunza pia. But I know it's going to be a very practical paper. Practical paper. Practical paper. You know, there are papers, if you don't know how to answer them, you'll always get it wrong. That's why even today, after I taught you AAA, mwanafunzi ananiambia sasa mwalimu, hii nimepita. Hii sasa nimepita. Ukifanya moja mbili kesho tena. Because ukishajua group audits, the practical aspect. Because those guys will never test you like the simple. You know, AAA and advanced taxation, they are not easy papers. Because they want you to be like consultants outside there. Be like consultants. But we'll talk about that later. For now, let's talk about this. Exam will be easy, Jaba, no. Inakwambia ukweli kabisa. Songok lazima upite. Itakuwa mingi sana theory. Theory itakuwa mingi sana. To concentrate. Let's focus here. So you see here, our returns must always be returns in form of what you percent. Our returns must be returns in form of percent. Kenya shillings returns, if you use them, you'll get a 0 in the entire question. So let me ask you a question, and I give you this example. Assuming you are a bread kind of a businessman who is buying and selling bread. So you buy bread for how much? For 50 shillings. And then you sell the same loaf of bread for 70 bob. Then what will be your profit in form of percentage? Profit in form of percentage. So you'll take the selling, which is 70, minus the buying, all over which one? Is it buying or selling? All over which one? Buying or selling? Buying or selling? Buying or selling? All over which one? Buying or selling? Always buying, isn't it? Always buying. So you take sell all over buying, which is 50. So basically you take sell minus buy over buy, like that. Sell minus buy over buy, like that. So 70 minus 50, that is 20 over 50. Guys are already giving me answer, 40%. Guys are giving me 40%. But a genius of a student will tell you no. This is a bad method. A genius of a student will tell you, mwalimu, just take the cell over by minus 1. Take the cell over by minus 1. The cell over by minus 1. Whatever you get times 100%. This is the approach I want as a, or new over old minus 1. Yes, same. So please apply that percentage, that method here. So if we apply that method here, this is what we shall get. This is very good. I like this because hii sasa hii ni hatari. Hii ni a genius here. So Rx. So this one here will be Rx in form of what your percentage. So you see now the buy is only 1, Buy is only 1. I bow. We shall have. So then this one here will be 35. Where mother, watch your maneno mother. So buying ni 30 minus 1. Mother, watch you view mother. Hii itakusaidia sana. Hakuna kubao. 42 divided by 30 minus 1. If I were you, I would just stand up, walk about a little bit, come back, finish this class. So 38 over 30 minus 1. Whatever I get times 100. Is there somebody who is able to confirm these answers? 2 exams. 2 days, 2 exams. Valo Chieng. So Mary Ann is saying that the first one is 17% or 16.66. 16.67. Wamesema mwalimu wa round off sana 16.67. Yeah. That is the first one. Kosovo, is that you calling? Hiyo inamaanisha namna gani? Hiyo mnatumia majina ngumu sana leo kwa nini? Hebu kwenda kwa ya pili. Hebu enda ya pili. Aliana niambia ya pili inafaa ikuwe 40%. 40%. Ya mwisho je hapa inafaa kuwa ngapi? Ya mwisho hapa inafaa kuwa ngapi? Ya mwisho kabisa inafaa kuwa ngapi? Ya mwisho kabisa inafaa kuwa ngapi? So then I would want us to we shall take a break. We shall take a break, and this is how we are doing it. This is how we are doing our break. This is how we are doing our break, ladies and gentlemen. I would want to stop there. But now remember, we have our early morning class. Do you remember our 5 a.m. class? Is it going to be there? What do you think? Will I get this same number? Yeah, Hamada nimefanya sana. Yeah. So we have the 5 because I remember you guys have done like AFR 5 hours. So I know when you see mother, especially a lady, bowing like that, getting out of wrestling. And ladies, really, they know how to, these guys here can really, really sacrifice. When you see them, it must be everybody. It must be everybody. It must be everybody. It must be everybody. Now, ladies and gentlemen, please remember our announcement regarding what year, regarding our Excel that you told me in the morning to work on. You know, guys keep on telling me that mwalimu, we know advanced Excel. Trust you, the people who know advanced Excel, unless you tell me you're working for the big 4. Most of us are not very good with advanced Excel. We have a 2-week course here for advanced Excel, where we are going to teach you things like pivot tables, etc. Many things there. Those are things that we normally charge like 80,000 per person to teach outside here. But we are charging our students our offer. Our offer has been 1,000 shillings. And we have said in this to extend. So this is 1,000 for advanced Excel. Please take this seriously because of your BDA and because of your work. So this advanced Excel, we have in this case here iTax. We have things like QuickBooks, Sage, etc. So each one of them, this is really value for money. This is really very, very, very fair to everybody. So, and remember, if you pay for the 3 at once, you pay 2,700. Even if you don't, like iTax, it's not about just, this is being taught by Felix. Felix works at KRA, all right? So in this case here we teach you how do you compute those tax obligations practically. And then how do you file them? Very, very important. And how do you do tax planning? Very, very important. So it will be very important, ladies and gentlemen, that you get to this. It will be a 2-week class, and I can assure you, mta gain so much. Today in the morning, niliwafanyia example moja Excel. Wanafunzi wakaniambia, mwalimu, we thought tunajua Excel. Kumbe hatujui. So this is very important for you. So if you would want to make any inquiries, we have our inquiries number. Actually, you guys don't need to inquire anything. Go ahead and pay. Our pay bill is 62,42,839. Account, just right there, short courses, like that. You can't go wrong. You can't go wrong. You can't go wrong with our advanced Excel. So many people have gone for interviews. Anaulizwa tupatie X lookup. Unapata ajui X lookup. Anaulizwa, for example, this is a trial balance. In 5 minutes, give us a P&L. Give us, in this case here, a balance sheet. In 5 minutes. They don't even know how to use some ifs to automate, in this case here, their financial reporting process. Remember, Excel is the most powerful tool. That is why you'll get even the sophisticated softwares like SAP. They always have an area where you export everything to Excel for you to be able to do dashboards, for you to be able to do, like pivot tables, all right? All right. The moment you combine advanced Excel, Power BI, and then later on, of course, I'll be able to teach some of you, the guys who are really tech savvy, we should be able to do Python for accountants. It's quite easy, programming for accountants. Ladies and gentlemen, that is where the world is going. Pana baki nyuma. So this one, I will be teaching you this immediately after your exams. We are starting on the 26th. On the 26th. There'll be late night classes like these ones. Late night classes. Kupumzika ni mbinguni. So take advantage of the offers and get value for money courses here. Value for money courses, which will come with what year? Certificates. It's part of our CSR as a RCM to ensure that our students are having courses, skills, which will be able to assist them outside there. So see you tomorrow at 5. I will be able to share the link immediately because I would want you guys to be as many as you are today. I can see guys saying cash on 9:30. No. Adjusted NPV is very good. I'll be able to do that. Money market, we shall overcome. No, we shall overcome. And the cover theory, no, 4 a.m. is too early for Ramsey. For me, it's 5 a.m. 5 a.m. and I'll share the link in all our groups here. Are there students who have joined us here today who are not in RCM's WhatsApp groups? Any students who have joined us today and they're not in RCM's, very new students. Perhaps they've been studying on their own or they have been going to other colleges. No worries. I would want to know whether you are there so that I can send you the link. Because how else will you be able to get the link? This is an extension of our today's free of charge class. Then what you do, if you are very, very new, you have to reach out to me. You can write a small WhatsApp message to me. And we're glad to have you around. You just write a small mail, Mwalimu, just drop that link for tomorrow. Oh, there will be a LM at 5 a.m. Could we do it maybe earlier or after? No, let's say, no. What do we do now? You guys are confusing Mwalimu.